but rather about various ideas that future products may borrow, and also about the reasons why do we need a decentralized system for shares. And I would like to start with why. Next slide, please. So with people who understand Bitcoin, you don't really have this problem of explaining why decentralized and unregulated is better than centralized and regulated. However, since we're not talking about currency anymore, but rather about companies and their shares, it all may be slightly questionable. So what I would like to do is to look at how companies are currently funded and then convince you that there's a better way. Or even if you already are convinced, then I think it's still very important to state explicitly what the goals of any kind of replacement for the current system should be. And obviously, decentralization is not a goal in itself. So I'd like to talk a little bit more about what the goals, what the real goals are, and then show you a possible implementation. The most important thing to understand about the current system is that it has rules. And all companies and individuals work within this governmental legal framework which defines those rules. And rules, they may be useful, that's true, but they have some major problems. They're very difficult to change, and they're very costly to navigate. And if we talk about corporate shares, then ultimately it is this governmental legal framework which defines rules on how to distribute shares and then how to distribute information that may affect those shares' prices. And these rules are very often ineffective. Some of you probably know insider trading happens all the time. And as I said, it takes a lot of time, money, and knowledge for companies and individuals to navigate this whole system. And the reason for high navigation costs is because those rules are issued not by the entities who actually use them, and also because it takes an actual human being to review and then enforce those rules. And rules are not applied automatically. So let me give you my first example. It would be rather difficult to invest in a private company as a minor shareholder. And think about Kickstarter for a moment and think about why they call it donations instead of investments. And one of the major reasons is precisely because it would be a nightmare to try and arrange a large group of people each invest in a small amount into a private company. At a minimum, they all would have to hire lawyers and go through all the legal procedures before they can safely invest their money. And needless to say that if the proposed investment is negligibly smaller than the amount spent on all the legal procedures, then people simply won't invest. And thus, this legal framework, current legal framework, basically denies companies opportunities to be funded, and it denies them access to a certain kind of capital. And that is not even mentioning possible costs for some disputes between those numerous minor shareholders. Next slide, please. Now, it would also be useful to demonstrate how rules prevent companies from gradually growing. And one can probably imagine a private company that is in need of a lot of capital and that considers going public. Now, going public usually means implementing a lot of changes within the organization as well as going through numerous legal procedures. And the current legal framework, it sets the rules, and it says that you can either be a private company or a public company, but you can't gradually grow. So it basically puts a thick red line right there. And you can probably implement certain legal workarounds and kind of like gradually grow, but all the costs of going public combined, they would simply, they may not justify the amount of capital that is being sought by the company. And it is also very difficult for companies to set various rules for investors. So companies do have some freedom. For instance, they have a choice to pay or not pay dividends, but this freedom is very limited, so it may not be possible to implement certain things that might be beneficial, but possibly more risky for both the company and its shareholders. Next slide, please. There's also a question of incentives that the current system creates. And I'm not an expert on public companies, so you are welcome to correct me here, but it is my understanding that for many public companies, the primary goal is growth and not revenue. And that is understandable because shareholders are by no means guaranteed any other kind of profit other than from selling their shares at a higher price. And the question, of course, is could there be a different set of rules that would benefit shareholders' interests in some other, well, let's say, healthier ways? So, next slide, please. From the examples I mentioned, we can already derive at least a number of goals for any kind of replacement for the current system. And the first goal is obviously make it cheaper for people to invest, followed by opening up more opportunities for companies to be funded. And then it's also important to provide cheaper way of litigation possible conflicts by automatically applying certain rules. And finally, we should allow more freedom in setting various rules for companies and its investors. And I am inclined to believe that it is this latter goal, allowing various rules, that may virtually guarantee that all other goals are achieved. So the central idea here is that it's not a question of what rules to have, but rather who's to decide on the rules. And the first question is usually a question the government tries to answer. But the proposition here is to move the decision-making to the parties actually involved into each particular deal. Next slide, please. So now that we see why we need a replacement and what the goals should be, let's talk about an actual implementation. And I propose that we start with what we already have, which is Bitcoin, and then just make another fork. And contrary to the colored coins approach, I would like you to imagine another fork, because it might not be, with all the changes that we are going to make in this fork, it may not be compatible or reasonable if we build the whole thing upon the existing blockchain. Next slide, please. So the first change would obviously be this. In Bitcoin, we only have one type of units, Bitcoins themselves, and there are no different kinds of Bitcoins, and the price of each Bitcoin is exactly the same at any one point in time. And this is contrary to a system in which we need shares that are attributed to various companies, and the obvious solution here is to allow various types of shares to exist. And in colored coins terminology, types of shares or types of units would be called colors. And here, by unit type, I basically mean some name for all the shares of one particular company. Next slide, please. A new unit type can be created by anyone who has the software. And the creation of a new unit type can be seen as an act of incorporation. Now, I would like to point out specifically that unit types are not units, because after the creation of a new type, one creates units themselves, and that is the difference from the colored coins approach, because as far as I understand, in colored coins, you don't really have, you don't create your own units, but rather just assign colors to them. And in the fork that I'm proposing, you do create your own units, and in a moment you'll see why it's important. But ultimately, it is the founder of the company who issues shares. He decides on how many units to issue, and in general, next slide, please. In general, it should be irrelevant how many units he decides to issue. So whether it's 1,000 or 1 million would in no way affect the initial price of a single unit, which is going to be zero anyway until the first purchase. Now, the important thing, of course, is that after the initial issuances, there should be no more additional issuances so as to prevent share dilution. And that is unless otherwise is specified in the rules. And now I'm going to talk about the most important part of the idea, the rules and how they are implemented. Next slide, please. In Bitcoin, as soon as units arrive and transactions are confirmed, the money are yours and you are free to do whatever you want with them. And it should be slightly less so with shares, because shares may have certain rules created by founders that may affect how future shareholders can distribute their shares. And those rules, obviously, they will be reflected in and will affect the price of each unit of this type. And because we're talking about software now, it's obvious we can't just have arbitrary rules. Somebody has to implement them. So if you are familiar with object-oriented programming terminology, I'm going to use it a little bit right now. I think we should have like classes or types of shares which are rules, classes or types of rules that are implemented, we see the next slide, please, that are implemented by actual developers of the software, and then those types of rules are instantiated into actual rules by those who issue shares, that is by founders. And I realize it sounds a little bit ambiguous and theoretical here, so let me give you an example so maybe you would instantly understand what I'm talking about. So let's say an entity may wish to appear loyal to its potential shareholders by creating a rule that says it's impossible to transfer more than 30% of shares from one address to another in a single day without the approval of the holders of the rest of 70% of shares. And this kind of rule, it may limit options for insider trading, and it would allow a company to find just the right balance, just the right combination to attract the maximum and the right kind of capital. Next slide, please. And so in this example, a type of rule is disallow transfer of shares from one address to another without the approval of shareholders. And the actual rule that is built upon it is built upon it by adding values such as how many shareholders, during what period of time, and from which addresses. Another example could be when a founder sets a rule by which shares, when offered for sale, should first be offered to a particular address and at the same or lower price. And obviously, this price aspect of this rule, it may require external verification from the Bitcoin blockchain or some stock exchanges and so on. Yet another rule may state to which degree a single share is divisible. And this is an interesting rule that, in combination with the number of shares that were actually issued, it may be a good instrument in controlling how many shareholders a company can have. And obviously, then it helps controlling the balance of power within the entity between its shareholders. And finally, we can probably imagine a rule that says it's impossible to change rules unless 99% of shareholders agree with that. And next slide, please. So the rule system allows for various combinations of powers to exist for various entities. And those rules are set before a single share is issued. And those who buy shares, they implicitly and voluntarily agree to those rules. And because they agree to those rules voluntarily, that means that those rules are seen not as a burden, which usually happens in the current legal system, but rather as a means of attracting capital. Next slide, please. Even more important is that the enforcement of those rules lies in the technical implementation of the protocol, and thus those rules cannot be changed through procedures not agreed upon beforehand. Most importantly, it becomes really easy, much easier to navigate those rules and a lot less costly to navigate them, precisely for the reason I just mentioned. So a question may be raised. Who guarantees a shareholder really owns a part of a company? And in the current legal framework, ultimately it is the government who does this, but the paperwork government has to review in order to determine whether this individual really owns a share in a company is ideologically no different from the blockchain of transactions we have in Bitcoin or the one that we might have in the proposed system. What's different is the cost of enforcement of what's written on a piece of paper or in the blockchain and the reliability of the enforcement. And in the case of the proposed system, it's obvious that in many cases those rules are applied automatically and the cost of enforcing them is zero. And in other cases when those rules are not cannot be applied automatically, that would probably mean that we might use some, they can be enforced with the help of the agreed upon mediator. Well, that would be it for my talk today. The final slide, please. My only hope is that it sparked at least a couple of ideas in your heads, and maybe some of you would come up with an even better vision or maybe an actual product. And I understand that we now have some time for questions, so if you have any, I would be happy to answer them. Yes, please.
I have a couple of questions, but in the interest of fairness, I'll only ask the first one.
Okay.
Bitcoin has this problem with the UTXO, the unconfirmed transactions that everybody has to continue to remember, or the unspent transactions that everybody has to continue to remember to know that when they get spent, that was a valid operation. And the fact that this is growing, partly because of Satoshi Dice, partly because of other factors, turns out that it's creating an increasing load on the network. Do you have any ideas as to when anybody can go onto the network, anybody with the software can create blockchain objects ex nihilo?
Yeah, like shares.
Then, I mean, even in the current situation, there's a worse it can get. If every Satoshi is living at a separate address, that's the absolute worst it can get. If if the variety of block and if the quantity of blockchain assets can grow without bound, then the size of the UTXO set can grow without bound. Do you have any ideas as to how to ameliorate that?
Well, I would say that, obviously, correct me if I'm wrong.
Can you summarize for people online who did not hear that through that mic? That would be good.
I'm sorry, what?
You can summarize the question for the people online.
Oh, excellent. So, if I understand correctly, the question was, would it create a certain problem of spamming the network with, creating various shares, and is that correct?
It's not spamming the network as far as transactions going back and forth, but in the amount of information that the network needs to remember long term.
Right.
In this proposal can grow without bound.
Well, I'm not going to lie to you. I'm not exactly like a core Bitcoin developer, so I might not know the answer. However, I do believe that there's a logical solution to that, and those people implement. I know there are a couple of people on this conference who do have an actual product that does something similar. So they might know better. You might probably be better off asking them. But I think the solution could be found. That is not like a major problem, but it is true. Yeah, go ahead.
I just wanted to comment on your question.
Yeah, this is the guy who actually knows a lot, so he can probably answer.
Okay, the question was like, if the unspent transaction output pool grows beyond the limits, it will cause a problem. I think it's pretty much the same problem as with the blockchain size. You have to keep like all the blocks so you can like securely like check all the whole transaction history, right? So for the unspent transaction outputs, you can also create some index, keep all of them on disk, quickly navigate only to check the transactions you want to check for the next block. So like if you have like 1 billion of transaction outputs, no problem, you will just check in your B3 or in some efficient index storage only those outputs that you need for the latest blocks that you received. So it's just a matter of like coding this up and keeping this somewhere on the disk, right?
Well, there's some extra factors to it. I want to give other people a chance to answer questions. We can talk about this after the session.
Yeah, I just want to share the idea that it's not as like new and critical problem.
The blockchain size and the UTXO pool size are slightly separate issues, and the B-tree controls the block pool size, but it cannot control the UTXO size because all the UTXOs still have to live in the B-tree.
Yes. So yeah, I mean, you just for the next box you need to search only some subset of transactions, and with B-tree it's quite efficient. So the only problem is about the hardware, hard disk space. So, no? Okay.
I don't want to argue about
Yeah. Okay.
Okay, thanks, guys. Yep.
So I'm a bit involved in the colored coins, and I noticed that you were talking a lot about colored coins, but that you actually talked about another fork or an AL chain. The idea of colored coins is separate of the chain, so it can be in Bitcoin or another AL chain. It's more about implementing something that's very client oriented and doesn't have any logic towards the chain itself. My question is whether you already looked into the implementations of this. So assuming there is like bits of proof, a colored coin, Bitcoin server, if you thought about the actual code, how do you code and implement rules about, of issuance? And if you looked at the technical part of this, and if it's possible to implement it even on the existing Bitcoin chain.
Right, I think the idea of implementation, this whole idea on the existing blockchain, I mean, it's possible, it's doable, but you would have a lot more like limitations. Some things you wouldn't be able to do, like the whole rule system and the whole idea with divisibility of shares that is set by those who issue shares. So yeah, I mean, various possible routes that we can take to implement this idea. I can see them, but in my view, a fork would probably be a better route because it would be a lot more like flexible, and the most important part of the whole story is the rules, right? The rules thing.
My question is, where do you see are the rules a part of this new blockchain? Are the rules a part of the mining process? Are the rules a part of how does the decentralization of the rules work?
Yeah, as I said, those rules, initially, classes of rules, they should be implemented by those who develop the software, and that is, obviously, each client should know about what kind of rules we may have. And then those who issue shares, they simply like set different values for those rules. That would be my vision. Maybe some of you would come up with an even better way to do that. Yep.
I love the idea. I just wanted to give you something else you can do, another rule set that might add more value to it. And that is, I want to start off with the observation that the reason why public companies that are exchanged in the NASDAQ, whatever, why shares in those companies hold value is because the legal system around it enforces whatever rules there are, right? So, and that's tied to the US dollar. And so, consequently, if you want to add more value to your system, you should probably have a way to back units of stock with other units of stock, such as, well, imagine having a company, and let's say my company's name is Apple, and my company's really rich. I have a lot of bitcoins, or some other unit of exchange. There should be a way for I should be able to create a rule that says if you own my stock, you can redeem the underlying asset of my company, so you can.
Okay, so what you're saying is to have an hierarchical system of and reliability, and that I think that is a great idea. So, for instance, you might have a very respected company, a big one, and then another company may emerge that would use a little bit of the reputation and backing of this parent company to start off, and so that people would trust this new company and buy its shares because they know that if this new company fails, at least they would get something out of the parent company.
Yeah, that's more valuable.
That's a great idea.
Not necessarily hierarchical. It could be very.
Sure, absolutely. Yeah. Yeah, it'd be nice to use a microphone because.
Cheers. So the question comes to mind for me is how this fits into the regulatory framework, right? Because you express concern with obeying local laws and regulations about this. Like in the US, it's extremely difficult to do things like take a company public. What occurs to me is that you could probably just shoehorn in the government as a sort of escrow party here. Issue of where all this data goes aside, whether it goes into the blockchain or in a separate alt chain or whatever, you could set it up and have the IRS or a bank or whoever act as the escrow party when issuing these shares. I really like this system, and as somebody who, I'm sure there's some other business owners in here, people don't like to obey the rules very often, and people will bend the rules. Your system is rather brilliant because it disallows people bending the rules. I don't even really know if that's a question, but I'm a big fan. I didn't realize what you were going to talk about here.
Okay, so I think the central idea that I'm not a big fan of centralized legal systems, and I'm a big fan of the idea of poly-legal systems. And if you want to learn more about how that could possibly work, I would probably recommend the book by an economist. What was the son of Milton Friedman? David Friedman, that's right, and he writes in his book, Machinery of Freedom, The Machinery of Freedom, he writes about poly-legal systems, and I think he has quite a great explanation of how that could possibly work. I think the more agents on the market you have that could possibly enforce the rules, the better it is, because people would have the opportunity to choose whatever rules they like, whatever companies that can enforce those rules they like, so I think this is great. And if you just have, we could possibly have this transitional period in which government may act as an institution that enforces those rules. But I'm not really sure that government would be very fond of this idea anyway. So we might have to come up with our own solutions. I'm sorry, who? Oh, lawyers. Yeah, I mean, lawyers, I think they can, it doesn't, because lawyers, they basically, right now, they work in this, in the monopoly, right? What they would have to do is to work for, various legal systems, and maybe that would add some complications, which I'm not really sure of. You would have different rules, different laws, and that's fine. I think they could adjust. I mean, that is not a problem for lawyers, except maybe that, well, some of them would lose their job because, oh yeah, I mean, exactly. That is the whole idea, because some kind of rules now can be enforced automatically. Why do we need a lawyer to do that? Exactly.
A couple of comments. You mentioned that you weren't sure if this was going to be something of interest to governments. I think there's a couple things you could do that might make it a little bit more interesting to folks that are thinking about it from that angle. The rule sets that you have, if you get with somebody who understands commodities or finance, you could probably map through a common set of properties that they deal in and come up with a rule set that mirrors something in the real world.
Yeah.
So you could say, this is the way IBM would be structured. This is the way Berkshire Hathaway would be structured. You could draw a couple of real-world examples like that and build what that rule set would be for that, that type of an organization. So you could start getting to people in their native language of businessese. The other thing that I thought is very interesting about this, if we're talking about putting this in a blockchain type structure, we're now talking about potentially an immutable data structure. So we have a public record of all of these transactions, every single transaction. So if those are registered addresses that are going back and forth, the government might absolutely fall in love with this, because they can see where everything has gone, and they can make sure that all of the rules are being followed according to policy.
Except that they do not know who owns the addresses.
And that's where the intersection between the regulation of this system to enhance their own regulations might actually be interesting to them, because they could do small things like say, well, if you're in the United States, since we're going to put lots of legal onus on you because you're in the United States, you have to register that address if you want to be above board. And if we find out you've been doing it with offshore addresses, you're going to have tax implications, just like you would typically. But I don't necessarily think that the government and existing legal and financial structure is going to hate this idea for the core. I think the core is very interesting to them. It's more about the details of implementation. Okay,
fair enough. I think so. I think some people would say that maybe we can somehow merge our interests with what a government has in its mind, but personally, I don't believe that, government would really love this idea. I don't believe I think they are very inert, all right? And that might be a problem.
Yeah, hi. A lot of thoughts. This is brilliant. There's one issue, and as maybe the least technical person in the room about Bitcoin, the answer is obvious. Your problem is transparency. And it's not transparency for government. You can figure out all that other stuff. It's transparency in terms of kind of the typical pump and dump scheme. I could say, hey, things are going great, and sell all my shares, and you don't know it. The regulations are really not about government interfering. It's about just ensuring some sort of fairness. And so you could have a fair system. And we've invested, and I'm a venture capitalist, I'm invested in systems that are outside the traditional framework. But that trust is the most important thing. So what's the mechanism that you could put in here for transparency and trust, so that you know that I'm issuing shares for my company, that I am not manipulating something and then front-running the market to be able to get out, or I'm holding back good news and I'm buying a whole bunch of stuff because I know that I just got a big order from somebody?
Right. So first of all, let's talk about the fact that the system is not exactly very transparent, especially for those who are not too familiar with it, right? So me, for example, I'm not familiar with the system, so if I started getting into it, I would find myself learning a lot of things and people doing things behind the scene. But the way that the transparency is achieved is by having certain rules that everybody knows, how they work, because they are implemented in actual code, and everybody.
You can't do it in anonymity, though. That's the thing. You cannot do it in anonymity.
No, you have just addresses, right? to which those rules apply.
But if you don't know that I am the person who knows more than you, there's information asymmetry. If you can't address that information asymmetry by putting some mechanism around that to make sure that, that if I'm doing something, it says, you know that I'm doing something. And so there are limits on what I can do without everybody understanding.
I definitely agree with the fact that, for some rules, for implementing some of the rules, you can implement them automatically, and you can have anonymity for those rules. But I wouldn't say that that we can't achieve anonymity with at least some of the rules. So I think it's a questionable statement.
There's an easy solution of saying Facebook Connect is the rule for any owner of shares, and that creates that transparency because it connects an identity and the actual transaction. So it loses the anonymity of the concept, but it connects it to the social world. So that could create the trust needed. So it could be a link between
At least on the issuer side, it can't be anonymous.
Right.
Otherwise,
because you need the history.
I can sell shares in Bill Gates' house.
Yeah, absolutely. I do think so. At least, yeah.
On the issuing side, it's really easy to ensure that the issuer of a particular blockchain asset is a particular person. We already have this idea, and it's used on the internet so much. For any site you go to that says HTTPS, you can get a certificate that verifies your identity. There's a bunch of well-known companies that their lives would be over if they forged certificates. So if you're going to create a blockchain asset, if you're going to say, okay, I'm making a new kind of thing that is issuing shares of my company, that action, which, if I'm understanding the proposal correctly, that action goes on the blockchain. It's something that the network remembers. If that includes a signature signed with a digital certificate from well-known CA, then it verifies, okay, this is actually the person who issued the security. And it's trivial, and most people do things this way in, for instance, a web browser. If you're going to make a non-technical client, a client for people who are maybe who are used to using an exchange, but knowledge of technology not so much, and you try to and you search for a particular security, and it isn't signed by anybody, that's easy to give them a big red warning and say, hey, this could be issued by some guy on an island somewhere that nobody's ever heard of. This could be issued by a demon. We have no way to know.
I think the central question is not, the identity, but rather the reputation. I mean, reputation does not mean that we can't have anonymity, right? So it doesn't matter if I tell you what my name is, but rather what my reputation is. Well, it may matter, right, for a certain enforcement of certain rules, but that is not, huh? Okay.
For Bitcoin, people mine the coins in order to generate the coins. In this case, you're talking about selling shares to raise money for a company. So you're planning on computing every share within the blockchain before you start?
Yeah, I mean...
The blockchain assets, other than whatever like, let's say you have a blockchain. In Bitcoin, the blockchain assets are created as part of the mining process. Presumably, to run a blockchain, you need such a blockchain asset. But the proposal is additional blockchain assets that people can create ex nihilo from nothing, that are not the unit of exchange, but whatever they're defined to be in the creation transaction, the transaction that creates these things.
Well, this is all really interesting, and it's interesting to hear you talk about.
Yeah, I guess we're out of time right now.
We are running out, but
yeah, thanks a lot. Thanks everybody for the questions, and again, I hope that sparked a couple of ideas that may be useful. Thanks a lot.